26 years of CNBC TV18.
Welcome to Market Masters. The underperformance of Indian equities has been emphatic this year. In a year-over-year calculation, the MSCI India index is actually down over 3%, nearly 4% actually, while North Asia, that is China, Korea and Taiwan, have given outsized gains between 100 and over 100%. But India has done far better if one looks at a 5 or a 10-year trajectory. So is it time for mean reversal in 2026? Or will India's slower nominal GDP growth keep earnings lower? And of course, will gold continue to be a good investment? For these and many other views on the market, I have with me Sridhar Sivaram of Enam. Thank you very much, Sridhar.
Thanks for inviting me, Latha.
It's always a pleasure having you with us. Okay, that time for mean reversal, that is a very big question we are all asking ourselves.
Yeah.
What's your sense? Do you think earnings are returning?
Yeah. So I think, Latha, last 6 quarters have been single-digit earnings growth. And I think the main reason for India's underperformance, you can give 100 reasons why India's underperformed, but if you ask me, the main and the structural reason is India has had very poor earnings growth in the last 6 quarters. And if you look at the performance of India over the last 6 quarters, roughly matches an underperformance because of single-digit earnings growth. So for me, that is the most important reason. Rest, you can say, oh, we don't have AI plays, we don't have this, we don't have commodity, or we don't have something else. But I think if earnings comes back, everything will fall into place. Our own view is that next year, which is FY27, we'll get at least 15 to 18% earnings growth. And as a result, we will see the market come back sometime from, say, early next year, sometime, maybe Jan, Feb. We don't know when the market turns, because by then you will start getting early signs of the Q3 results, which we think will be better than Q2. And I think that should be the start. As we saw from the data that, markets have cycles, and India has done very well. If you take 10-year performance, there are just 3 or 4 large markets which have given you, closer to 10% return, and India is one of them.
And these are dollar returns.
And these are dollar returns, exactly. Our currency has depreciated significantly over this period. And so I think there are cycles when, markets underperform. This is one of those. We can't have year
after year.
Every year having, strong positive returns. That's how markets are. And I think it's part of the game. So you have to understand when valuations are high, try to be cautious. And you need to know, when to go
when to step in and what.
Yeah. This looks like a time to, step in. I mean, we've been cautious for almost 9 months.
Let me take you up on that.
Sure.
Step in. Where would you step in? Is it financials? Is it IT, which has got beaten down a lot and perhaps a little misunderstood? Or is it e-commerce, where they're promising this?
So, Latha, you briefly spoke about nominal GDP. We actually think that nominal GDP also has been one of the reasons for poor earnings.
Okay, then let me postpone my sectoral question and come to...
So, I'll combine both. So our own view is that both government and Reserve Bank have pivoted. They have understood that the low nominal GDP is a problem for the government, also for the corporates. As a result, also a problem for tax collection. So if you see the GST cut, we think is a move from the government to boost consumption. And once you have stronger consumption, the constant, complaint about low capex by private sector. When we speak to private sector, their point is, if there is demand, we'll put capex. If there is no demand, you can't be expecting us to put capex just for the sake of it. We think this is a chicken and egg story. The government has taken the first step. They have taken multiple steps, by the way. Also, if I see what Reserve Bank has done in terms of cutting rates, also, if I add to that, their liberal view on getting capital into the financial sector is all, in my view, a concerted effort by the government and Reserve Bank to get growth back. I mean, let's accept it, the real GDP number doesn't feel on the ground. The nominal GDP actually tells you a story. So I think that is the basis. So if I flip from there to what should be in the market, financials do look good because we think we are in the late stage of the rate cut cycle, but we think it will be lower for longer. I am not in the camp who thinks that we are going to get rate hike in, say, 9 months or a year. We could see sustained low, below 4% inflation for, say, another 9 months or even a year. So lower rates will help more, loan
will help
growth.
margins of banks
Exactly.
for sure.
So, and NBFC. So we like financials as a space. We think NBFCs do very well when the rate cycle is low. Banks should do well, ignoring one more quarter of some issues because of the rate cut. They should do well. This is a space which looks well. Consumption is the other space which looks well. Discretionary consumption, higher end. We think still there is issue with rural consumption. A low food price effectively means that the farmer is not
a part of the rural India is affected.
So there is a part of rural India which still hurts. But we think that
So it will be more autos.
So it could be autos, it could be higher end discretionary consumption. Yeah, it could be any of those, travel, tourism,
Hotels.
all of that, hotels. So there is a whole host which you can take from there. The rest is actually very bottom up. We do like pharmaceuticals because there are a lot of stories emerging from there. It's a lot of bottom up stories emerging.
What about the e-commerce guys? I mean, Swiggy is raising money right away. And you have Eternal, you have enough Nykaa, you have other kinds of e-commerce plays.
So my personal view is some of them are looking interesting because of the correction in the value. Some of them look still very expensive. So it's a mixed bag. So you can't paint that all e-commerce looks good. Some of them still look very expensive. But that is a space where there is growth. Whether it is profitable growth, time will tell. But there is very strong growth. And there's competition also emerging. So as an investor, you have to be very nuanced in that as to whether you want to participate or not. Wherever we don't see value, we just stay away.
Okay. Speaking of value, we are in the season of IPOs. In fact, yesterday we had Ashish Gupta of Axis AMC strongly arguing that, we all are getting carried away by the FPI angle to shares being depressed. Shares are depressed because the supply is huge from IPOs. What is your word on that sector? Do you like any of the plays?
Yeah, so I think we broadly skipped most IPOs. One, because the valuations are very high. And what we've also seen is that growth promised by many of the companies coming to IPOs haven't actually materialized. The other thing is one of the mutual fund heads mentioned to me that incrementally the mutual fund inflows are lesser than the supply. So if they have to then participate in a supply which is an IPO,
they have to sell something else.
Yeah, they have to sell something. Whereas in the earlier days, the supply was so much higher, the inflow was so much higher that they always had the problem, which is that you're carrying to build more cash.
Yep.
So I think that's a tipping point where the mutual funds then have to figure out whether you want to participate in an IPO by selling some existing stock or not. So I think supply is an issue. Hopefully, as newer IPOs start to underperform, we will see that, sanity will prevail in the market.
Yeah, and the issuers taper off.
Exactly. That's what.
It's not just that they're coming at fabulous prices, they're also coming in droves. Yes. And then the lock-in will end and that supply comes. Okay, a question that before I lose time, gold.
Yes.
It's given, I always thank you for opening my eyes to the sovereign bonds. I did not even think of them. Now they are phased out because they were so good for the investor.
Yes.
But does gold and silver continue to attract you?
Yeah, so Latha, I've been very positive on gold, silver for a long time now. I think it's done very well. It's up 50%, almost 60% this year.
My fear is mean reversal over there.
Silver's up almost 100%. In my view, both gold, at least gold will surely give, my broad view is it should give about 8 to 10% normalized return in rupees, because 3.5% currency depreciation, gold should do about 7-8%. You'll get somewhere in the range of 10-11% over a period. Obviously, if it's given 60%, it's highly possible that there is some mean reversion and gold corrects. But my broad view is it's an asset allocation call. You should at least have 10% in gold / silver. Easier way to play either is the ETF, or you can look at the miners. Miners is a good option. There are a lot of mutual funds which invest in feeder funds of mining companies.
Okay.
So the thing in mining companies is the miners are not being priced at gold, which is the current price, which is say 3,000, 4,000, whatever is the exact dollar, or $60 for silver. They are not priced at that, priced at much lower. So there is an upside there. But there are no plays in India. So these are feeder funds overseas. But I am still positive on both.
Okay, as expected, I'm being warned that we've overshot. But just a word, how crucial is this trade deal with the US? If that happens, do stars turn entirely for us? Or is it not that material? We have learned to live with it.
So I think it is material. It makes a difference. We cannot antagonize US, which is one of the largest economy. But it looks like India is learning to live without the trade deal. It doesn't look like India is in a hurry to sign. The fact that the Russian premier is in India and India is talking.
You're wearing it on us.
Yeah. So it looks like India has decided, or some sort of agreement that we have to live with this. Few sectors get affected. A lot of the other sectors have got exemptions. So I think it isn't a big deal now. It does make a difference, but I think India is learning to live without the trade deal. That's my view, that looking at what is happening in Delhi, it looks like that could be one of the reasons.
Okay, but let's see. There is also a team here to negotiate.
Yes.
So for all you know, we may get some good news.
Yes.
Hoping it in 2025 now looks a little difficult, but maybe FY26. Well, we have to wind up on this excellent edition of Market Masters. Thank you very much for joining us, Sridhar Sivaram. Take a break. Thereafter, Chartbusters.
"26 years of CNBC TV18